There is this stark, almost brutal reality in the world of real estate that nobody really wants to talk about when they're uh, drawing up their dream
Oh,
blueprints.
absolutely. The fun part is the vision.
Right. You can have this incredible vision for a property. You can secure the ideal location, have this eye for design that would make an architect weep, and build a spreadsheet that predicts these massive returns.
But if you don't have the capital to back it up, none of it matters.
Exactly. Without money, you are a sunk ship. It just doesn't matter how beautiful the destination is if you literally cannot afford to leave the harbor.
Yeah, you're just staring at the water.
Right. And for you, the listener, navigating this space, funding isn't just some bureaucratic step you have to check off. It is the absolute bridge between your ambition and actual action.
I'd go so far as to say it's the single biggest filter in the industry.
Yeah.
Real estate, unlike, launching a digital business from your laptop or buying some index funds, it requires massive tangible capital.
Right. Real physical money.
Yeah, the barrier to entry isn't just having a good idea, it's figuring out how to construct that bridge of funding without it just completely collapsing under the weight of the project itself.
Which is the exact mission we are taking on today in this deep dive. We are looking at a masterclass in building that bridge, drawing from the book Raising Money for Real Estate Investment. Close deals, raise money, build wealth.
Such a great resource.
It really is. The book is by Willem Tait. And just to give you some context on our guide for today, Willem Tait is an author of multiple books. He's a management consultant and a seasoned mentor. You should absolutely check the description for his links and socials because the frameworks he provides, they are incredibly practical.
What becomes immediately apparent in his approach is that funding, it isn't treated as just some math equation you have to solve.
Right. It's not just plugging numbers into Excel.
Exactly. It's a strategic tool. Like the way you structure your capital stack fundamentally dictates the lifespan and the success of what you're trying to build.
So, our game plan for this deep dive is to start by exploring advanced syndication strategies for large-scale commercial projects.
The heavy hitters.
Yeah, the big stuff. And then from there, we're going to push into the future a bit and uncover how non-traditional pathways like global crowdfunding and tokenized assets, how they are basically rewriting the rules of access.
Which is wild stuff.
Oh, it's completely changing the game. And then finally, we will dig into the practical, highly psychological communication strategies that actually keep private investors trusting you with their capital over the long haul.
That progression makes perfect sense, honestly. Before anyone can start leveraging futuristic decentralized funding models, they have to understand the core mechanics of how large commercial deals are traditionally put together.
Right, the fundamentals.
Yeah, you have to understand the physical interplay between the money you own and the money you owe.
Ugh. Ah, the classic dance between equity and debt. The book offers this analogy here that I think really grounds the whole concept. It frames equity, so the ownership, the hard cash commitment, the skin in the game, as the foundation of a building.
The base you stand on.
Right, it provides the unshakable stability. Debt, on the other hand, like the leverage, the bank loans, that's the scaffolding.
I love that visual.
It's so good. It supports your vision and allows the structure to reach new heights that a foundation alone could just never achieve.
Because if you try to build a massive foundation with zero scaffolding, you might have absolute stability, but you're only ever going to build a single-story house.
Yeah, you severely cap your potential scale.
Exactly. Conversely, if you construct this massive, towering scaffolding on a tiny, weak foundation, the slightest change in the economic wind, like a market dip or a spike in interest rates, or even just a few vacant months, it will send the entire structure toppling over.
Okay, let's unpack this. Specifically, this concept of syndication. Because syndication is kind of the ultimate tool for scaling into commercial development when your own personal foundation just isn't big enough to support the scaffolding required for a massive project.
Right, when you just don't have millions of dollars sitting around.
Exactly. I like to think of a syndication sponsor almost like a movie director.
Oh, interesting.
Yeah, so the investors, they are the Hollywood studio putting up all the capital, but the sponsor is the one on set, day in and day out, actually making the vision happen.
Right, they are managing the chaos.
Exactly. They're managing the cast and crew, which in this case means the contractors, the city planners, the property managers, and when the movie is a blockbuster, both the studio and the director share in the box office returns.
That analogy holds up perfectly when you look at the daily operations. The investors provide the fuel, but the sponsor is essentially driving the car.
Yeah, absolutely.
And if we connect this to the bigger picture, Syndication is essentially a massive risk-sharing mechanism.
Hmm.
Historically, acquiring a 100-unit apartment complex or, downtown office building, that was a monopoly held by mega-wealthy institutions.
Right, and normal people couldn't even get in the room.
Never. Syndication democratizes that access by pooling resources together.
There is a story in the book about an investor named Sophia that I think really highlights the mechanics of this perfectly.
Yeah.
So Sophia wanted to level up from doing small residential flips, and she wanted to buy a 100-unit apartment complex valued at $8 million.
A massive jump.
Oh, huge.
Right.
And obviously, Sophia does not have $8 million in liquid cash just sitting in a checking account.
Right. Very few individuals do. And honestly, if she did, tying up $8 million of personal liquidity into a single physical asset is a terrible misallocation of risk anyway.
Right. You'd want to spread that out.
Yeah.
So she steps into that director role. She becomes the sponsor. She goes out and forms a syndication, bringing together 15 private investors.
Gathering the studio executives.
Exactly. And together, they pool $2.5 million in equity. So that is their collective foundation.
A very solid base.
Yeah. And with that strong foundation poured, she is then able to go to a commercial bank and secure a $5.5 million loan. So there is the scaffolding.
Right, the debt leverage.
But if I'm putting myself in the shoes of one of those 15 investors, I might be a little nervous.
Oh, Corey.
Like if I give Sophia $100,000 and the whole project just completely goes belly up, is the bank going to come after my personal house to pay off that $5.5 million loan?
Right, and this raises a really important question about liability, which is exactly why syndications are structured the way they are.
So how do they protect the investors?
Well, the investors are typically brought in as limited partners in a specific limited liability company, or an LLC, that's created solely for that one property.
Okay, so they are legally insulated.
It's exactly. Furthermore, the debt Sophia secures is usually non-recourse debt. That means if everything falls apart, the bank can take back the apartment building, but they absolutely cannot go after the personal assets of the limited partners.
Oh, wow.
Yeah, the investor's liability is strictly capped at the initial money they put in.
Well, that makes the pitch to the investors a lot more palatable.
Oh, massively.
Right. So now Sophia doesn't just buy this building to sit on it. She implements this massive value-add strategy.
She gets to work.
Yeah, she modernizes the units, upgrades the common areas, and improves the whole management efficiency. And by doing this, the book notes that she boosted the net operating income, or the NOI, by 40%.
Which is huge.
Yeah, and because of that, the property value skyrocketed from $8 million to $11 million. But wait, let me just stop there. Because why does a 40% bump in rental income translate to a massive $3 million jump in the actual value of the building?
This is where commercial real estate separates itself entirely from residential. It's a completely different game.
How so?
Well, if you own a single-family house, its value is dictated by comparable sales. It totally depends on what your neighbor's house sold for last month.
Right, the comps.
Right. But commercial real estate doesn't care about the building next door at all. It is valued like a standalone business, using something called a capitalization rate, or cap rate.
Okay, so the value is derived purely from the revenue it actually generates.
Precisely. The market determines a multiple for that specific type of asset in that specific city. So if Sophia increases the profit, the NOI, the value of the building, goes up strictly based on that mathematical formula.
Wow.
Yeah, she basically forced the appreciation.
Which means those 15 investors not only got consistent returns from the higher rents she was bringing in, but when Sophia eventually goes to sell or refinance that building, they get to share in a massive $3 million pie of newly created wealth.
It's a beautiful system when it works.
It is, but here's the friction point. Sophia had to find 15 people willing to write hefty checks.
Right. Not an easy task.
No, and she hit the ceiling of a local, tightly knit network. What happens when a sponsor needs to raise, say, $8 million in equity, and they just don't have a Rolodex of wealthy local investors? How do you scale trust past your own living room?
Well, you leverage the internet to expand your living room to the entire globe. We're seeing this massive transition right now from the physical boardroom to digital platforms.
Right.
The underlying principle of pooling resources is totally identical to what Sophia did, but the delivery mechanism has fundamentally evolved.
Which brings us to the non-traditional pathways. crowdfunding and tokenized assets.
Yes, the frontier.
So crowdfunding platforms like Fundrise or Realty Mogul, they take that barrier to entry we just discussed and absolutely shatter it.
They blow it wide open.
Suddenly, you don't need to be an accredited millionaire to invest in a commercial syndicate. You can literally buy into a massive industrial park in Texas or an apartment building in Florida with as little as $1,000.
It's incredible. It allows the everyday person to achieve geographic and asset class diversification in a way that was literally impossible 20 years ago.
Here's where it gets really interesting, though. The book dives deep into tokenized real estate.
Yes.
And I have to push back a little bit here on behalf of the listener, because whenever the word token gets thrown around, people's guards just naturally go up.
Oh, completely. It sounds scammy to a lot of people.
Right. Isn't tokenization just a fancy tech bro buzzword for crowdfunding?
Yeah.
I mean, if I'm putting $1,000 into a building, what is the actual difference between going to a crowdfunding website and buying a blockchain token?
It is a vital distinction to make because on the surface, from the user's perspective, they look very similar.
It feels the same.
You are buying a fraction of a property in both scenarios.
Right.
But tokenization is built on blockchain technology using smart contracts. And that changes the underlying physics of the investment,
In what way?
specifically regarding liquidity.
Okay, because in traditional crowdfunding, your money is essentially locked in a vault, right?
Yes, in traditional crowdfunding, your investment is tied to a specific centralized platform. It is highly illiquid. You cannot just sell your $1,000 share of that apartment building whenever you suddenly need cash.
You're stuck.
Yeah, you generally have to wait for a predetermined liquidity event, like the sponsor selling the building 5 or 7 years down the line. Tokenization changes that entirely by digitizing the ownership into tokens that exist on a public blockchain.
So it essentially turns a physical, static building into a liquid asset.
Exactly.
It's kind of like turning a commercial skyscraper into a publicly traded stock that I can just trade on an app.
Theoretically, yes.
Yeah.
If you own 10 tokens of a luxury hotel and you suddenly need capital to pay for your kids' college tuition, you can sell those tokens on a secondary digital market to a buyer in London or Tokyo almost instantly without needing the sponsor's permission or going through a broker.
Okay, but how does the blockchain actually know the building made money? I mean, a smart contract is just software. It can't walk into the hotel lobby, check the cash register, and then distribute the profits to my digital wallet.
That's the part that trips people up. But the mechanism bridging the physical building to the digital blockchain is actually fascinating.
How does it work?
It relies on API integrations. So the physical hotel uses property management software to track all the rent and expenses.
Normal software.
Right. And that software is linked to a traditional bank account. When the net profits hit that bank account, an automated data feed, which is often called an oracle in blockchain terms, verifies the deposit and triggers the smart contract automatically.
Wow. Okay.
And then the smart contract instantly and flawlessly distributes the corresponding fractional dividends to the thousands of digital wallets holding the tokens. No middlemen, no accountants spending days mailing out paper checks.
That completely removes the friction of all that back office administration. And it is not just theoretical. There is a story in the book about a team in Denver building a mixed-use development. So, retail space, offices, residential units.
A massive undertaking.
Yeah, the total cost was a whopping $20 million. They secured $12 million from traditional loans and government urban revitalization grants.
A good chunk, but not enough.
Right. They were still $8 million short of their foundation.
And an $8 million gap is where a lot of projects simply die on the vine.
Exactly. But instead of just giving up or hunting for a mega institutional partner who would probably take all the control, they creatively funded that remaining $8 million by selling digital tokens to tech-savvy investors globally.
It's a smart play.
And what is brilliant about this is the secondary effect it had. By using a cutting-edge token sale, they didn't just raise capital, they generated massive public relations buzz.
They essentially weaponized their funding mechanism into a viral marketing campaign. I mean, when thousands of people globally own a digital token of a trendy new development in Denver, they talk about it online. They post about it on social media.
Because they own a piece of it.
Exactly. The investors become a decentralized street team for the property before the foundation is even poured.
But, and I think this is the pivot point of the whole book, honestly, technology, smart contracts, clever marketing, they might get you the money. A viral token sale might fill your bank account initially.
Yeah?
But human relationships and trust are what keep the money over the long term.
We really have to transition from the cold mathematical mechanics of acquiring capital to the warm, highly complex psychology of managing the actual human beings who provide it.
Absolutely.
Because whether an investor hands you a physical check in a boardroom or they buy a digital token from a continent away, they are a partner, not an ATM.
Right, and the book is incredibly firm on this standard. Maintaining long-term trust requires just a religious dedication to transparency, to setting clear expectations early on, and strictly adhering to regular reporting.
What's non-negotiable?
And it does not always have to be, complex financial spreadsheets either. The book details a sponsor named Lisa who secured a private investor for her very first apartment project.
I love this example.
Yeah, she didn't just take the money and go silent for a year while she worked on it. She sent monthly updates, including just simple photos of the framing going up and later photos of the drywall being installed.
What's fascinating here is the psychology behind why a photo of drywall is so incredibly effective.
Right, because it sounds so mundane.
It does. But when an investor wires a massive amount of capital to a sponsor, they experience an immediate loss of control.
Oh, totally.
And that loss of control breeds anxiety. The investor's subconscious starts wondering if the money just vanished into a spreadsheet or if it was mismanaged somehow.
So the photo of the drywall isn't just a basic progress report. It is psychological proof that their money exists in the physical world.
Exactly. It visually validates their decision to trust the sponsor. And Lisa actually took it a step further. When the project was near completion, she brought the investor to the site for a personal hard hat tour.
And the result of that psychological management, that feeling of being included in the journey, directly led to that exact same investor funding her second, much larger commercial development.
It's the ultimate win.
Yeah, she didn't have to go hunting for capital for project number 2 because she properly nurtured the capital from project number 1.
It compounds.
So what does this all mean? I look at managing investors exactly like a long-term relationship. If you are dating someone, you cannot just ghost them when things get hard.
Definitely not.
Right. If you had a rough patch at work, you don't just stop communicating for a month and expect your partner to be sitting there happily when you finally figure it out. That is the exact moment you need to over-communicate.
Yet sponsors often fall into the trap of assuming investors only want to hear from them when there is positive news.
They want to hide the bad stuff.
Yeah, they think silence is a better strategy than sharing a minor setback. But anyone who has been in real estate longer than a week knows that construction gets delayed, materials get stuck in transit, pipes unexpectedly burst.
Things go wrong.
Hiccups are baked into the asset class.
Right, and the investor isn't judging you on the fact that a hiccup happened. They're judging your reaction to the hiccup.
Exactly.
Which perfectly frames a scenario in the book with a sponsor named Alex. So Alex is running a project, and out of nowhere, they hit severe permitting delays.
The worst.
The city is dragging its feet, the timeline is slipping by months, and naturally, costs are rising. It is the classic bad news scenario.
And the instinct for a less experienced sponsor would be to hide.
Yeah, just panic in silence.
Exactly, to ignore the investor's emails while frantically calling the city planner every hour, just hoping to magically fix the problem before the next quarterly report goes out.
But Alex did the exact opposite. He organized an immediate conference call with his investor pool. He did not sugarcoat the reality at all.
He faced it head on.
He explained the exact bureaucratic issue with the permits, outlined the specific next steps he was taking to pressure the city, and gave them a firm date for the next update.
And by proactively calling that meeting, Alex maintained total control of the narrative.
He didn't let rumors start.
Right. He positioned himself not as a victim of a sluggish city council, but as a competent, transparent leader actively managing a crisis.
Yeah.
Proactive honesty is the ultimate retention strategy. If he had hidden the delay and the investors found out by, say, driving by a stagnant construction site, the foundation of trust would have completely cracked, and they never would have funded him again.
It all comes full circle to that foundation. I mean, you can build the most complex debt scaffolding imaginable. You can use the most advanced blockchain smart contracts to distribute equity globally. But if the human foundation of trust is cracked, the entire structure comes down.
Trust is literally the one variable the sponsor has absolute control over.
Yeah.
You cannot control macroeconomic interest rates. You can't control the cost of raw materials.
No.
But you have complete agency over how consistently and honestly you communicate with the people fueling your vision.
Well said. What a dense, incredible journey this has been. Thank you so much to you, the listener, for joining us on this deep dive. We have covered a massive amount of conceptual ground today.
We really have.
We started with the foundational power of syndication, pooling resources, and sharing risk to tackle commercial projects that seem entirely out of reach for a single individual.
Democratizing the process.
Exactly. Then we ventured into the cutting-edge mechanics of tokenized assets, exploring how smart contracts and global crowdfunding are quite literally turning physical skyscrapers into liquid assets.
Just mind-blowing technology.
Yeah, it is. And then we anchored it all back to the timeless psychological element of trust, transparency, and the simple power of a drywall photo.
It truly operates as a comprehensive playbook for anyone looking to scale their real estate ambitions, really from the mathematics of the deal all the way to the management of the people.
And as a reminder, the architect behind these frameworks is Willem Tait. He's an author of multiple books, a management consultant, and a mentor who truly understands both the math and the psychology of this industry. If you want to dive deeper into his strategies, please go check the description of this deep dive to find his links and socials.
I highly recommend doing so. The actionable insights in his work are indispensable for navigating this space.
But before we officially sign off today, I want to leave you with a final provocative thought to mull over. We spent time today unpacking tokenization, right? The reality that a $20 million building could be split into thousands of digital tokens actively traded on secondary markets.
Yeah.
Well, if this technology continues to scale and the friction of investing drops to absolute zero, where anyone in the world can buy a $1,000 fraction of a commercial skyscraper right from their smartphone while riding the subway, how will that fundamentally change what it means to be a real estate mogul in the future?
It forces us to ask if the era of the sole monolithic landlord is finally coming to an end.
Right. Will the traditional landlord be entirely replaced by thousands of micro-owners managing properties collectively through decentralized smart contracts? If money is the bridge that keeps your ship from sinking, well, maybe tomorrow's bridge isn't built by one giant institutional bank, but by 10,000 ordinary people, each laying down a single digital brick.
It's a fascinating shift to think about.
Something to definitely think about. Until next time, keep learning, keep building, and we'll catch you on the next deep dive.